what blockchain is, which is good. So we'll go in a little deeper on that. And then just general stuff in terms of encryption. Hardly anyone's read the Bitcoin white paper, so that's, I'll have a couple things for you to, either videos to watch or things that you should read if you really want to start understanding a little more. I'll cover a lot of the basics today, but there will be fun stuff to do when you go home. So, cool. Here's all the reasons that everyone wanted to spend your evening with me. So, great. So we will get into it. So as I mentioned, goals of this, there's a lot of things to cover in terms of building decentralized applications, in terms of building on the using the blockchain. A lot of things to learn with cryptocurrencies, and you can go super deep in all of those different angles. But some of the feedback that I'd like to get, going to do a high-level intro today. So if you know everything, then, well, maybe you should be teaching it, but it may be a little boring for you today. But the goal is that I can understand what people are looking to get out of these so that I can help kind of steer the talks that we give and where we go with this program. So today's just the basics of Bitcoin, blockchain. Eventually, we'll get into Ethereum, smart contracts, things like that. Get you running an Ethereum node, allow you to send currency on the Ethereum network, have your own wallet, and then being able to interact with the Ethereum blockchain with one of their clients, it's called Geth. It's a Go client that gives you a REPL to interact with the blockchain. So, and then at the end of the day, teach you about what smart contracts are and teach you the skills to be able to learn and program in Solidity, which is the programming language of Ethereum. So I kind of went through a lot of stuff you probably don't know what I'm talking about, and so hopefully it'll be something we get to and you learn a little bit more. So today, just high-level intro to cryptocurrencies, high-level intro to Bitcoin, blockchain, and then at the end we can talk about how we want to continue this going forward. So I'm going to start this with a quick little intro. This won't be all. So how many people here know what Bitcoin is? Okay. How many people know what blockchain is? Okay. So I'm going to play this for people who may not have a strong understanding from a technical standpoint, to get the functionality of this is what we're doing, this is why blockchain exists, and then we can go into some of the technical details and then view a lot more technical info on it. But this is a good primer for those who may know nothing about what blockchain is, what Bitcoin is, so we'll go from there.
So without any jargon or scary math. It is not, however, an introduction to what Bitcoin is or why it matters. For that, check out the great intro video at bitcoin.org. With that said, on to how it works. Bitcoin lets people exchange money electronically as easily as sending an email or text. To send money, you use what's called a wallet app to type in an amount, enter or scan a recipient's account number, and hit send. The recipient will then see the money pop up in their account. So how does this work? At a basic level, Bitcoin is just a ledger with account numbers and balances. When Bob sends Carol 5 Bitcoins, his balance goes down by 5 and Carol's up by 5. There's no gold or government-issued money backing these numbers, just people's belief that the numbers are worth something, and a system that prevents unfair changes. Part of the system makes sure no one can spend money from someone else's account. Every time you hit send, your wallet app sends a message to the Bitcoin network describing how the ledger should change, including the sender's and recipient's account numbers and amount to transfer. So what's to prevent a thief from creating a message transferring money from someone else's account? Bitcoin requires a kind of signature on each message to prove that it was created by the true account owner. The signature serves the same purpose as a handwritten signature on a paper check, but it's based on math rather than handwriting. The math comes from the world of cryptography, which is normally used to hide secret messages, but in Bitcoin has been repurposed to prove ownership. Each Bitcoin account number has an associated key that only the true account owner knows and is used to create signatures by encrypting transaction messages. Others test the signature by trying to decrypt it. If successful, they know the signature was created by the true account owner. In addition to not relying on handwriting analysis, these math-based signatures can't be copied and reused on other transactions, since the signatures are unique to each transaction. So these signatures keep unauthorized transactions from changing the ledger, but who exactly is checking the signatures and overall maintaining the ledger? Surprisingly, anyone who wants to. One of the main goals of Bitcoin is to provide a decentralized system, meaning no single company or government can control it. Every time someone sends money, a transaction message is passed around to all the people who want to help maintain the ledger, who all call maintainers. Each maintainer keeps a personal copy of the ledger and updates it whenever they receive a new transaction with a valid signature. With ledgers spread all over the world, traffic delays and occasionally fraud can lead to differences in those ledgers. So how does the world decide which version to use? Like in other democratic systems, there's a vote, but it's a bit different than a typical ballot system. Maintainers vote by trying to solve a special puzzle based on their version of the ledger. The first person to solve a puzzle announces their solution, and everyone updates to that version. So the vote turns out to be a kind of mathematical race, but it's designed to favor the majority's version. This is because the more people there are working on a particular version, the faster it will be solved. Because new transactions are constantly being generated, this voting process repeats over and over again, so maintainers can continually agree about new transactions. So why math problems instead of, say, emailing in votes to decide on a ledger? Without a central authority to register voters, it would be hard to enforce one vote per person. A single person could create multiple accounts to vote more than once, or even millions of times. The math problems prevent this by making each vote have a cost in computers and electricity. This means outvoting or outsolving the majority to take over the ledger would effectively require outspending the majority, an unlikely event. So the math enables a fair vote in a decentralized system. Two more important details about how it does this. To prevent someone from pre-solving a puzzle to win the race, each puzzle builds on previous answers, and the winner is not just the most recent solution, but the ledger version with the most total solutions. The puzzles are also extraordinarily special in that there are no tricks to solving them faster, other than by buying more computers and electricity. It's this property that underlies the entire system and gives people assurance that the solutions are truly from the majority and not a clever attacker. A final note about how money is created. Every time a puzzle is solved, a small award is added to the solver's balance, effectively creating money out of thin air. This award acts as an incentive for people to help maintain the ledger, and is in addition to small fees attached to transactions. Because maintainers acquire newly created money through computation, they are typically called miners, but their main purpose is really to manage the ledger, not to create money. The voting system simply provides a convenient way to randomly distribute money into the world, and in fact, after 2140, no more money will be created. In summary, Bitcoin is an electronic currency that's based on a collaboratively maintained ledger. People transfer money by sending messages to maintainers describing where and how much money should move. Maintainers make sure that the messages are from the true account owners by checking digital signatures. And finally, the maintainers reach consensus with each other through a math-based voting process. I hope this gives you a quick sense for how Bitcoin works. If you'd like to dive deeper into the rabbit hole, check out my 22-minute...
All right, cool. So, does everyone understand it now? We good? Yeah, or she didn't know. Okay, cool. So, that's hopefully to give the people who haven't done anything with cryptocurrency, don't understand Bitcoin, don't understand blockchain, a little idea on how Bitcoin works and some of the moving parts behind it. So, starting off around what cryptocurrencies are. Cryptocurrencies, it's a currency where you're using encryption in order to secure the funds and to send funds. It requires a distributed ledger. There's no centralized authority. That's the whole purpose around Bitcoin. The whole reason it exists is to remove these intermediaries that are the trust sources that can be compromised, that can have their own agendas. What Bitcoin went out, and really what any cryptocurrency is out to do, is to allow each end user to have full access to the data and have control over their own personal data or money or currency within the system. As I mentioned, it's decentralized and operates independent of any central authority. There's no bank, there's no any single point that you can go to, which is great if you want, your own control over your money, control over what happens to it. Nobody can take away your money like they can take away or freeze your accounts in a bank. When you give a bank your money, you're giving them your money, and they have a promise to give you that money back. But in reality, and as you've seen in a lot of Greece and Cyprus and some other areas, governments can shut down your ability to withdraw money, and there's nothing you can do about it because you gave the bank your money. So with a lot of the financial crisis, Bitcoin and a lot of cryptocurrencies came out with the goal of giving you complete control over your money, and that's great. But on the downside, the way you secure it is with a private key and through encryption. And if you lose your private key, then you cannot access your money. And there's no bank to call, there's no reset password, there's nothing. Your money's there. And there's a lot of people who have Bitcoin that exists that they can look at and they can see it, but they can't access it. So it's kind of the downside. You get a lot of ownership over your money, but you also have a lot of responsibility to maintain it, keep it safe, keep it secure. So for a while there's been efforts to create digital money. In the 90s there were a lot of different experiments, a lot of the cypherpunk movement, trying to create kind of a libertarian mindset to help create money that was independent of any government and any existing bank. 2000s there were also some efforts, but at the end of the day they were all centralized. And 2008, and they all had a lot of problems. In 2008, Bitcoin came along, and Bitcoin solved a really hard problem, which a lot of the other cryptocurrencies couldn't, and it's called the double spend problem, and we'll talk about that. But starting in 2009, Satoshi Nakamoto, who is a person or a group of people, nobody really knows, but they created a fully decentralized cryptocurrency. This was the introduction of the blockchain, and their goal was to create a currency where there is a fixed supply. So going back to financial crisis and a lot of the libertarian roots of Bitcoin is that governments can just inflate and keep printing more and more money, deflating the value of that. So Bitcoin, looking at it kind of as a digital gold and having a fixed supply so that there will only be 21 million Bitcoin that are ever created, and with a very mathematical way of how Bitcoin are introduced into the world. So on the double spend problem, it's obvious if you think of any digital asset that you have, you think of email. If I send an email to Arshita, it goes out, it gets stored on a server, there's a copy of it there, that email then gets sent around to another server, there's a copy of it there, then gets delivered, it could be to a local client, there's a copy of it there. Digital assets it was just really hard to do. So the double spend problem, the issues that they got into with all these other currencies, that I could send, I can send a Bitcoin to you and I can send a Bitcoin to you, and you can't both spend that Bitcoin, right? Previously you could do that, and then I would get a product, another product would come in, and they're both not valid, and now I'm getting two products when I spent the same money. If you think about it with a check, if I write this, if I only have $100 in my bank account and I write a physical check to two different people, it's whoever gets there first wins. But that's because there's a central authority that's monitoring. With Bitcoin, they brought along that mathematical authority, and that was really the blockchain that helped eliminate this double spend problem. Being able to have a digital asset that you say, okay, I have $50, you have 50 and you can have 50. Well, that doesn't line up. So Bitcoin users protect themselves from double spending by waiting for confirmations. And so and we'll get into what confirmations are, but basically it involves the blockchain to enable and say, okay, this person really does have $50 or one Bitcoin, and I trust them because of the history in the ledger. And as you get more and more confirmations, it becomes even harder to reverse. So if I have if I want to send Pada one Bitcoin, I broadcast it to the network, broadcast the transaction to the network. Miners can then include that in a block, and I'll show a picture there, but essentially it goes out, miners go out, they package a whole bunch of transactions into a block, and then they start going through a mathematical formula. Here, miners create blocks by solving the proof of work for that block and saying, okay, there's a chain, there's the blockchain, and my group of transactions are going to be the next transactions that go onto the blockchain, which means these are valid transactions. A new block is put on the blockchain, give or take every 10 minutes. That's the goal. It definitely fluctuates. And a transaction should not be considered confirmed until it's a certain amount of blocks deep. So we'll go through some of that. So as a buyer, if we go back to the double spend problem, if we send one Bitcoin, if this buyer has one Bitcoin in their wallet and they send them a Bitcoin and them a Bitcoin, seller B can go through and say, okay, I'm going to put it on here. Seller A puts, their transaction gets put in a block, and as subsequent blocks get put on, that's when you're increasing the number of confirmations. So these are both blocks that contain a transaction. So buyer to seller B, there's a transaction in this block that says buyer to seller B, and in the transactions, there's a buyer to seller A. Now, we'll get into the mining, but as more and more blocks get put on the blockchain, their confirmations increase for that transaction, because with each block it's being confirmed going back, and it confirms that the blockchain is correct going all the way back.
So is there like a Schrodinger situation where both the transaction from buyer to seller A and buyer to seller B exists at the same time before any new blocks are added?
So there's different, and so what ends up happening is as you get longer and longer, the longer chain wins, right? So in this case, even if there was another person that wanted to say, okay, well, this block is valid, they're usually doing something funny with the system and trying to hack it, but in reality, once this block is confirmed, a message goes out like, okay, the next block is found. Now the miners pack together another block of transactions and try to solve the mathematical puzzle again. Once that mathematical puzzle, we'll go into the guts of it, that mathematical puzzle is solved, they win and they get their block put on the blockchain.
So is the confirmation instant, or would it take some time?
No, it takes time. So it's that proof of work that we'll talk about. Proof of work is solving really hard mathematical guessing. I mean, just guessing problems where you want to get a hash that has starts with 14 zeros or something. So it's a really hard, the probability of you getting it is really hard. And that's how they can monitor how hard it is to put a new block, is how many leading zeros that random string needs to create. So that's how they can, they can treat that.
So why would seller A's block be confirmed more than seller B's block if they're all at the same point in time?
It's consensus. So it's, all these blocks are going, and at some point, another miner will say, well, no, I'm looking at this. If you're comparing histories, so this is all just a history, right? And they could say, well, there's more history, and this is a bigger chain because it's the whole blockchain goes this way, and they're trying to say, okay, this is the next one, and then they're looking at this one. Well, this one's longer, so there's more validation to it. So I'm gonna stop working on this chain, and this is the brand new blockchain.
So what about the first one that's added to the seller A?
The first, so this is seller A's where their transaction is, and then some other transaction happens. Someone solves the formula, their block gets to go on, and then another group of transactions are put into a block, problem solved, and that goes on the blockchain. So you keep adding these transactions. Transactions get put in a block, and then you guess, and I guess the right number, so mine go in. Now everyone has to start all over again.
And the transactions are added to the seller A block because there's more consensus in seller A's block.
Say that again?
And the transactions are added to seller A's block because there's more consensus in seller A's block. Is that what you're saying?
Seller B's block, yeah. Seller B, yeah, it's a shorter chain. The longest chain wins is the saying, right? So if you have a longer chain, there's been more work done to prove that out.
then I understand that longer chain wins, except the question is that, so in order to get the next link in the block, so like in order to get the longer chain, what is the stop value from getting the first chain longer, the first chain, like the first next square, earlier than zealot A gets first next square?
Well, I mean, because there are network delays. You can get, and that's like a much deeper thing on how different consensus algorithms, but how they're coming to consensus, and really the miners want to work. They're rewarded only if they're putting valid, good blocks onto the right chain. So they're incentivized to ensure that they're on the longest chain, the best chain, so that the next block they put on, they will get rewarded. Because if I'm a miner and I put something here, and then we find out that that's not the main chain, then I don't get rewarded with 12.5 Bitcoin, right? So, in the back.
How fast do these transactions take place?
So they
are humans, they can't work so like,
what's that?
how fast do these transactions take place?
So it's all algorithms that run. It's approximately, it says disposal time is like 10 minutes, but it can be anywhere. Sometimes it takes an hour
Yeah,
to get a
because
block.
they are humans accepting or rejecting these.
No, nope. It's all algorithms.
The blocks they're working in, those are
It's algorithms. So you'll run a Bitcoin node, and that code is running, listening. And it's just a giant peer-to-peer network, and everyone's listening for a broadcast in terms of, hey, there's a new block. Okay, great. I'm going to go to. There's a pending pool of transactions. There's a lot of transactions that are just sitting in a waiting state. I bundle a bunch of them together. You generally do that. Whoever has the most fees attached to it, and we can get into that later. And they bundle it up, and they start solving a mathematical problem that nowadays only specialized ASIC machines or GPUs are doing that calculation. All they're doing, they're running a guessing machine, and we'll talk about that a little bit. But it's machines that are just running guessing, trying to get a number that, a random string that starts with, 14 leading zeros, which is hard to do, and that's why we have, just massive mining operations where it's just these very specialized hardware that run and just do hashing algorithms to try to generate more guesses. So that's all mining is, just trying to generate more guesses and be right, and then you get your block of transactions added, and then accept the Bitcoin in return. So there's no humans involved at all. It's all fully decentralized, fully just running on people's, in data centers and all over the world. So. So proof of work, this is what we were talking about in terms of the mining. Taking a piece of data, it's difficult, time-consuming to produce, but you can verify it very easily. Like I said, it's a random string, it's a random process with low probability of getting it right away, so that you have to keep guessing. You have to spend electricity and cooling time and processing time in order to guess enough times to get the right answer. So lots of trial and error. And so yeah, like if you're doing a SHA-256 hash, the odds of you getting leading zeros is really tricky. So an example, so if you just take the string hello world, so Bitcoin data is obviously much more complex, so we'll do a simple. If you have a string hello world, and the goal is to find, so basically if you're going to take, there's a thing called a nonce, and it's an integer value that you will keep appending and then incrementing to that string each subsequent run, trying to come up with a hash result that starts with 4 4s in this situation. So as you can see here, so here's our hello world string, and then we're going to append 0 on it. And 0 is the nonce, it's just this incrementing number. And you do a hash, and it doesn't start in zeros. You do it again, no zeros. So on the 4,251st time, with 4250 appended to that, we get a string from that hash, from hashing the string with 4 zeros. That then means, and if the rules at that time and the difficulty, like I said, if you want to increase difficulty and make it harder and have to consume more power to generate a new block and to guess correctly and have your block of transactions put on blockchain, then you can make it, you can make it 8. You can make it longer. And the more leading zeros you need to have, the harder it is, the lower probability that you're going to get that. So it takes longer. And it's literally just a string with the leading zeros being the thing that makes it tough, right? Does that make sense? How many people are lost? Probably be more hands up. Okay. So this is the way mining works and how you get rewarded with getting your block on the blockchain. So as I said, process of adding transactions to Bitcoin's ledger. The miner's job is to validate all of the previous transactions and be able to put new transactions onto the blockchain. I said there's a pending awaiting confirmation pool where they gather these to put them in their block. Allows Bitcoin to reach a secure and tamper-resistant consensus. It's by hashing what Bitcoin is actually hashing against is previous history. So if you change the past, then the present block won't make sense, which makes it a very tamper-resistant, because everything in Bitcoin or a blockchain in reality builds off of that history. So if you ever change the history and the way it's doing hashing, if you change any of that history, it'll change the hash values of everything going forward. So if I'm a miner and I'm mining and I check that history, it won't add up, or it won't make sense going backwards, and they'll know that there's been some modification. They do a lot of this with Merkle trees, which is a topic for a different day. But through mining, that's how new Bitcoin is created, as I mentioned. So here's an example. As you can see, blocks are increasing, going this way. As time goes this way, each block, the arrows probably show the one going the other way, but they point back, and there's a previous hash of that block, and that's kind of what I was mentioning, where the previous hash needs to point to this hash, and if you hash this, the value of this, and it doesn't equal that, then there's something's been modified within the blockchain, and that's what makes it immutable, where you can't go back and change it. So if you think of the blockchain as a database, it's a database that you can't go back and change the history on. You can't overwrite something that happened. You can only change going forward what is on there. So as you can see, it goes forward. There's that nonce value, so you can see you do get very high values. I'll add another. This is the layout of the block. All your transactions will be bundled under here, and then just pointers to the previous block that you're referencing and that you've built your history on. Miner rewards. So when Bitcoin, the first Bitcoin that was mined in 2009, they were rewarded 50 Bitcoin for getting that. I forget what there's a planned schedule, so by, I forget what year they said it was, it'll eventually stop sending Bitcoin out for any time you put a block out, and you'll just be collecting fees. But they're going to keep having the amount of Bitcoin that is introduced into the world by half until I forget what the day was. Yeah. But
so would mining Bitcoins be profitable at the moment? 12.5 Bitcoins per.
So right now it's 12.5. Yeah, so one Bitcoin is like $5,600. Oh, is it? Yeah, well, changes quickly. So, but yeah, so it depends, right? You need super cheap power. You need access to ASIC machines, which are customized specifically to mining Bitcoin. They do nothing but, those hashing functions very, very fast. So yeah, you need cheap electricity so you can do cooling, so you can run the machines, so you can have more machines. For cryptocurrencies like Ethereum, they use GPUs, so that's why NVIDIA's stock price has gone through the roof, because they're selling out. Nobody can buy GPUs anymore because everyone's buying them for mining. So if you're doing it on a large scale and you have the right stuff and you have cheap power, it could be profitable. You may only get a couple Bitcoin a month, but depending on all those other factors. So it's tricky. I mean, there's tons of people doing it, so it is. You get a lot in China where it's a lot of cheap power. You have a lot of people in the US next to like dams or hydropower, things like that.
So is there one like around the West New York area?
Yeah, there's one in Rochester. It used to be in Batavia, called Savage IO. I can bring them in to give a talk at some point too. So they do mining. They also do mining as a service. So if you want to mine, you pay to purchase the devices, and they manage it. They attach it to different mining pools across the world and all that stuff. So, and there's a local startup in Buffalo where they're using shipping containers to build out mining rigs that they can send to like Chile, where there's certain areas that are producing too much power and they can't sell it back to the grid, so they have all this excess power, so they can utilize that. So, yeah, there's some, but yeah. You got a question?
Okay. So I could actually move to a place with cheap electricity, like let's say Mexico, and I could set up servers and stuff, and I could just mine bitcoins from there.
Well, you could do the mining. So when you're doing the mining, you're connecting to the Bitcoin network, running these mathematical computations, hoping you guess right enough time, and you get rewarded with Bitcoin. Whether you sell that to maintain the operations, whether you hold on to it and hope it goes from $2,000 to $5,700 to $10,000, that's a different business model. But yeah, I mean, cheap power is the key.
How about let's say like a MacBook, like a standard MacBook?
Nope. No, they're very specific. If there's so much hash power, which is what they call it, you can't do it anymore. Back in the day, you used to be able to, but now you need very, very specific, customized hardware to do it.
Oh, do you know like any good websites for?
I mean, Antmain is the main one, and they're producing it. So, but yeah, they're
Dan?
4,000. Yeah.
Can you repeat the question?
Oh, sorry.
That's all right. Now I heard it.
Okay. The question was, can you run it on a laptop, a MacBook or something? And the answer is nope. You gotta buy custom.
Oh, okay, that's what.
Yeah. Can you mine? No. I mean, back in the day, you used to be able to run it on a laptop, but those days are long gone, and now there's giant companies focused solely on, setting up data centers next to cheap power, just running. So, and the machines keep getting faster and faster. So, and there's other stuff we can talk about at a later date. Called proof of stake. We don't have to do any of this mining. So right now, I think Bitcoin consumes the same amount of power as the whole country of Ireland in just power usage. So obviously, it's not a sustainable environmentally and a bunch of other reasons. But there's things called proof of stake. That's a different way of coming to consensus. And if you do proof of stake, that's there's certain consensus algorithms you're running where you're putting some of your money up to say this is the longest chain. But we can get into that. That's a totally different conversation.
Bitcoin specific, does the whole system have to remain consensus? Every single node has to agree that this is the way to proceed going forward, or how does that?
Yeah. So I mean, there'll be consensus on the longest chain, and people can try to modify the chain, or chains can get out of sync, but it's whatever one has the most blocks on it. What has the most confirmation, which has the most history behind it, that becomes the most valid one. And the miners are incentivized to only work on the longest chain. So there, you know, people won't keep mining two separate chains because you won't, you know, you're not going to be rewarded with the, you know.
You said Bitcoin employs proof of work, and you were just talking about proof of stake. How do those two different?
Man, that's like an hour-long conversation. Yeah, we'll get that. So at a high level, proof of work is I'm running those hashing functions on super high power machines and just doing a lot of guesses, burning a lot of electricity. Proof of stake is getting everyone in a room, and everyone puts in a large amount of money that gets held in escrow, and then you have the right to use certain algorithms to vote on is this block, is this chain the right chain? And there's different proof of stake algorithms like Tendermint and other things like that that allow you to come to consensus without having to do all the proof of work. So
Are there a lot more bonds that coming out right now?
that's where Ethereum, which is the second largest cryptocurrency, Ethereum is looking to move in that direction. And they had a fork today of the code, which is like a first step, kind of getting a lot of things in place. There'll be another hard fork of the code, basically upgrade of the Ethereum network that will allow proof of stake to be live. Yeah.
So how does the finding some value that hashes to something that starts with the zeros play into this process? I guess
Right.
I sort of missed that.
Sure. So what happens? So actually, you know what? I got a good. Hang on. Here you go. So this is from my Ether wallet. So this is Ethereum specific. But if you look at, you know, you're in your wallet and you sign a transaction, and you send it in through, it goes into this transaction pool, and all these transactions sit around. And the miners then go and say, okay, I'm going to grab this one, this one, this one, this one, and it can be based on fees. So each transaction that you send across the Bitcoin network or the Ethereum network, Ethereum uses a thing called gas, but it's basically a fee. So you can say, I'm going to raise the fees that I'm willing to pay for this transaction to go across because I want it to go a little faster. And if there's generally like standard, okay, if you have a standard fee level, you'll be processed in about, you know, X amount of time. But if you increase it, your odds of being picked up as a transaction that then gets put into a block that goes on the blockchain increases, right? So the miners will say, okay, I'm going to take a transaction. When they're bundling all that up, it gets on there, and if they guess properly, it goes on. That becomes the next block on the blockchain.
Okay, so they're competing to try to find that value that gets appended to the string
Yep.
that hashes to something with that correct amount of leading zeros.
Yep.
Okay.
Yep, and that's basically how you win the lottery. You win the lot. You know, everybody, like everyone in this room could have their own different configuration of transactions that they want to make the next block. And the reason you want to make it the next block because you get all the transaction fees. So that's why everybody picks the transactions with the highest transaction fee, because they get all those transaction fees if they're selected, and they get rewarded with the currently 12.5 Bitcoin or Ethereum or whatever it is. So that's the incentive for them to do that. Yeah, makes sense?
Yes, 100%. Thanks.
Yeah, and they're just trying to win the lottery. And if you win the lottery, you're the special one that gets to, you know, put your block up there. So good. All right, where was I? Okay. So yeah, fees and incentive of the miners to include that transaction. I talked about all that. So that's blockchain, or that's Bitcoin miners, things like that. Any other questions? Great. So blockchain. So we did talk about blockchain. We went through some examples of it, but at a high level, it's a decentralized and distributed ledger. There's no central database. If you think of databases, there's, you know, a MySQL database or something like that that exists, and everyone connects into it. With the blockchain, everybody gets a copy of the entire history of transactions that have ever happened. So and everyone has it. So it's distributed amongst everyone. Nobody can go in and just hack it or steal it or change it. Yes?
So a professor I was working with from Texas A&M over the summer was concerned about the size of the ledger, that it would become too big for everyone to have a copy of.
Sure. Yeah, and there's ways of doing, this goes into Merkle trees and where you can have light clients, and that's what they're working on right now is, I know Ethereum is, so you can have a light client. So you only need a certain portion of the blockchain in order to work on it. And with mathematical proofs, there's ways to know that that still is valid to another part of the blockchain, and that is a valid blockchain. And there's sharding and things like that. Ethereum's working on sharding so that you can have multiple versions of it, and it still all makes sense across different shards. So yeah, it's being worked on because it is getting a lot bigger and more transactions and the size of it. And, if you go to start up an Ethereum node, it's going to take you, depending on internet and whether you have a solid state drive, it'll take you 6 hours, 8 hours, maybe longer, just to download all those previous transactions. So yeah, with blockchain, you can't modify the past. And yeah, so the use of blockchain for Bitcoin made the first currency to solve the digital or the double spend problem. Just another example, as time goes on, each block is referencing the previous block. More of this, just a lot of these photos. All right, and we already saw this. So cool. So to recap, and I guess if there's any other questions, let me know. I figured a good way to do this is to go through, kind of dig in a little bit, answer some questions. I was going to play a more technical version of that video, and then we can kind of talk a little bit more about next steps. Go from there. So.
Let's see, I got this here. Bitcoin is just a digital file or ledger that contains
So this would be similar, but
balances,
a little more
and
technical.
people exchange money by changing this file. When Bob sells Carol a lawnmower for 5.2 bitcoins, Bob's balance goes up by 5.2 and Carol's down by 5.2. There's no gold or government-issued money backing these numbers. Bob is only willing to trade his real-life lawnmower for a higher number in this digital file because he has faith that other people will also trust the system. So who maintains this ledger and makes sure no one cheats? One goal of Bitcoin is to avoid any centralized control, so every participant maintains their own copy of the ledger. One surprising consequence of this is that everyone can see everyone else's balances, although the real system only uses account numbers and not names, so there's some level of anonymity. If everyone maintains their own ledger, how are all the ledgers kept in sync as money is transferred? At a basic level, when you want to send money, you simply tell everyone else by broadcasting a message with your account number, the receivers, and the amount. Everyone across the entire world then updates their ledger. As a quick aside, I'm describing how Bitcoin works for power users, people who help maintain the system. You can also just use the system to send and receive money, though, without maintaining a ledger. If sending money is as simple as creating a message with some account numbers, what's to stop a thief, Alice, from spending Bob's money by using his account number? Like a pen and paper check, Bitcoin requires a kind of signature to prove that the sender is the real owner of an account, but it's based on math rather than handwriting. When a new account number is created, it comes along with a private key mathematically linked to that account number. If you've heard of a Bitcoin wallet, these keys are what it holds and are what allow you to create signatures. To create a signature, a private key and the text from a transaction are fed into a special cryptographic function. Another function allows other people to check the signature, making sure it was created by the account owner and that it applies to that specific transaction. Unlike the handwritten version, these signatures can't be copied and reused in the future, as they're unique to each transaction. While the mathematical signatures prove who sent a transaction, they can't prove when it was sent, and this turns out to be problematic. In our traditional banking system, if Alice wrote 2 checks but only had enough money to cover one of them, the bank would pay the first person attempting to cash his check, but refuse the second because Alice's account would be empty. So the order of these checks is critical because it determines who should get paid. Unfortunately, order is much harder to determine in Bitcoin, where instead of a single bank, there are individuals all over the world. Network delays might cause transactions to arrive in different orders in different places, and fraudsters could lie about timestamps. 2 recipients might both think their transaction is first and ship a product, effectively allowing Alice to spend money twice. Bitcoin prevents this by providing a way for the entire world to decide on transaction order. As new transactions are created, they go into a pool of pending transactions, and from here they'll be sorted into a giant chain that locks in their order. To select which transaction is next, a kind of mathematical lottery is held. Participants select a pending transaction of their choice and begin trying to solve a special problem that will link it to the end of the chain. The first person to find a solution wins and gets to have their transaction selected as next in the chain. So what's this linking problem? It's based on a special function called a cryptographic hash. As scary as this sounds, it just mixes up its inputs and spits out a number, but it's special because it's irreversible. There's no easy way to start with an output and then find an input that generates it other than by making lots of guesses. And this is literally what people are doing in Bitcoin, feeding this function random numbers until the output meets certain criteria. The Besides a random guess, you also input a transaction from the pending pool and chain, which is where the linking part comes in. So the lottery provides a way for the entire world to decide which transaction is next, but the math behind it also helps ensure everyone agrees about past transactions too. Suppose you're joining the network for the first time and request a copy of the transaction chain to get caught up but receive several different versions. Which one should you trust? Ideally, you would trust the one that the majority of people are using, but determining this on the internet is difficult. What would stop a single person from voting millions of times? Bitcoin prevents this by requiring people to solve math problems to vote. This causes each vote to have a cost in computing power, making it unlikely that a single person or group could ever afford to outvote or outcompute the majority of users. The transaction ordering process described before actually provides the voting system. Part of the input to the linking problem is a transaction from the end of a chain, so each guess is effectively a vote for that chain. But how are all the votes tallied? Because the cryptographic hash function has well-defined statistical properties, you can look at any given answer and estimate how many guesses it took to find it, just like estimating how many coin flips it would take to get 100 heads in a row. So the links in a chain not only put transactions in order, but also act as an effective vote tally, making it easy to see which chain most people are using. Finally, how does money get created? Every time someone wins the lottery to pick the next transaction in the chain, new bitcoins are created out of thin air and awarded to their account. Solving these problems is commonly called mining, as this is how money enters the system, but the main purpose of the math is to make sure everyone's ledgers agree. The math simply provides a convenient way to randomly distribute money into the world. In fact, sometime around 2140, no more money will be created, and participants will only be paid from fees added onto transactions. I hope this gives you a quick sense for how Bitcoin works. If you'd like a more detailed summary, check out my 22-minute video, How Bitcoin Works Under the Hood.
Cool. So I have that as a
homework. Like I said, there's a local group here in Buffalo. I think we have about 170 people on our Slack group, and it's mainly local people. Whether we're doing meetups, we do meetups every morning downtown, and I'll send this out. And I know you guys have a Slack channel. I'll send all the slides. Where we go to different conferences, we have people doing talks, and that's Tuesday mornings. Some technical talks. Sometimes it's nothing, no agenda, but just talking about different things going on because this industry moves so quickly. Sign up for that. It's a great place to ask questions, and we have some top people in the. There we go. Okay. We have some really smart people around the topic that can help out. And then I'd recommend, so there's a 20-minute version of the videos I showed. I think those are really good. They get across the message, but the 20-minute version will get into a little bit more of the technical depth of what's going on, and watch that just like a bunch of times. And who here has read the Bitcoin white paper? Oh, okay, 2 people now. There's only 1 on the survey. Bina didn't take the survey, and that's what happened. So, okay. So my recommendation would be to, watch this video, read the Bitcoin white paper, read the Ethereum white paper, and if you really want to get into some of the guts and very technical pieces, you can read the yellow paper. Yeah.
Can you tell me the relationship with Gavin Wood and Wikipedia?
So he's one of the
But they don't publicize it like that. The real
like most things in life, when you get groups of people together working on projects that then become worth, $30-40 billion, there's certain politics and things in place. So I think when he was Gavin Wood was one of the original developers. He was really the guy who wrote the yellow paper. So he was, in a way, the first developer. He was the person who built Ethereum. Vitalik Buterin is the kind of the idea guy, and Gavin Wood was the guy that went out and executed on it and built it, or built a lot of it, not all of it, but definitely laid out the technical specs of what Ethereum would be. And I want to get into Ethereum next week or next session as well, but yeah, at some point they had different views on how things should be done, and there was a little split.
Because Ethereum hosted doesn't even attribute it to Gavin Wood.
Yeah, there's politics and stuff, but yeah. So after so in Ethereum, basically there was the Ethereum currency and blockchain, and what Ethereum allows you to do is create these things called smart contracts. Smart contracts, if you think of a legal contract where I'm buying a house, I need to pay, I'm buying a house, so I need to pay, $200,000 to buy this house, and I have to deal with a lawyer, and the lawyer then is holding money in escrow so that the seller can say, hey, when they have $200,000 in escrow and enough to pay for the house, then you can send them, the deed to the house, and then the lawyer will pay the seller. So anytime there's that middleman, trusted entity in the middle that is providing trust, smart contracts can automate. So what we now have is legal contracts that in legalese say you must do this upon this date by doing this, and then you sign, if you're buying a house, you sign 500 times, and lawyers take care of it. Smart contracts are, think of legal documents, but enacted and written in code, so that if you think of any escrow agent where it's, if you put in $5 and this other person puts in $5 and this other person puts in $5, you can have a smart contract that says, hey, if at any, if you send $15 worth into this smart contract, then this other, say a charity, it'll automatically do it. And it's all code. Nobody owns it. Nobody can control it. Once it's out on the blockchain, if you interact with it, then it'll do what the code says it could do. So Ethereum was built as a kind of global computer that could run these smart contracts that allow you to send money, and depending on who's sending the money, how much money is being sent, automated actions happen. So they created this thing called the DAO, which is a decentralized autonomous organization. So basically you can create a company that's code and built out to legal. So basically they created this smart contract that people could put Ethereum funds into, and then there would be a voting mechanism to vote on basically projects that were built on top of Ethereum. So think of like a venture fund or a Kickstarter with no Kickstarter and just some code that runs everywhere on the internet. And what happened, there was a bug in that code. There was $160 million that was locked up in that smart contract, and there was a code and there was a bug in the code, and someone figured out the code. It was able to siphon off money, basically siphon off Ether into a different address. So Ethereum had this, I guess, political debate on should they fork the code in order to stop this hacker from withdrawing, which is very much outside of the whole decentralized nature, but the miners would go around and basically vote on which chain they wanted to use. So Ethereum had a hard fork, and they said, okay, we're gonna erase, we're gonna hard fork, and that DAO never existed on our new version of reality, this new chain. And other people, thought that they shouldn't have done that, and there's still a lot of debate. That's why there's a thing called Ethereum Classic. So, but a lot of that political, after the whole DAO incident, there was a lot of issues. So a lot of people kind of scattered. So, but ladies first.
Alright, what if that happens again? So, you know, talk about how we doubt.
Yep.
What happens again in the blockchain?
So it could happen, but if there's not consensus around what chain, so if they say, hey, we want to go back to what the Ethereum blockchain looked like a year ago, they could do that, but the reality is, are people going to use that blockchain? Are people going to, go and use the new Ethereum? No, that other chain, like, no, you can't get rid of the initial chain. You can only fork off of it, right, and do something different, and hope that other people also agree with your viewpoint on the other chain being bad and this one being better. And the miners would also need to then also think that one's more worthwhile than the other one. So Bitcoin had this recently, where they had a fork, and then there's Bitcoin. So there's Bitcoin, and then a lot of people had different views on how the Bitcoin network and blockchain should operate. So they forked off, and then you have Bitcoin Cash, and now there's another one that's going on as well, where they want to fork off and create Bitcoin Gold. So, and it's all just differences on how, really philosophical differences on how Bitcoin should work and what Bitcoin should be, and somewhat religious in a way. But the beauty is there's no one to say like this is what it is. It's whatever the people and the miners, whatever chain they decide to follow after the fork. So, doing forks, so Ethereum had a hard fork last night, but not every hard fork means that there's going to be another chain. I mean, technically there's a chain, but it'll die off and no one, it's more of how they upgrade the network. So Ethereum's adding all these new features and going towards proof of stake and updates to how smart contracts work. And all of that stuff it's only implemented and upgraded through hard forks, or well, the soft forks, but hard forks are kind of how they make the big leaps to new versions. So forks they're not always contentious. So, yep.
Hey, so when you're also thinking about the DAOs, decentralized autonomous organizations, do you feel like ultimately that DAOs will be adopted by the users or replace so like a payment, for example, or like
So
these sort of processes like concepts?
So I don't think, no, because I think those are created to try to destroy those trusted entities, right?
Ultimately, those trusted entities have a lot of power in our society. Do you feel like that blockchain will overcome that sort of thing?
Yeah, I think there'll be a slow transition. So you look at, Goldman has their own version of Ethereum. There's Ripple, which is this cryptocurrency that allows settlement on the back between countries for banks. A lot of people want to use blockchain for, whether it's supply chain logistics, because there is that immutable ledger. If you're tracking shipments, there's nobody can go back and change that. And so it gives you that history that everyone can access. So I think it'll be, for certain things, there's machine-to-machine payments, things like that, that'll automate a lot of stuff. But I think eventually, at some point, it'll really start to make an impact on them. But we're kind of in that, they equate it to being like 1995 on the internet, right? The web was kind of there, but what you can do on the web then and what you can do on the web now is completely different, right? So we're still super early in it, which is why I think it's so exciting. But a lot of it is trying to figure out what these use cases are, and there's different camps. There's the Ethereum Alliance, which is a bunch of giant corporations that are looking, how do we leverage Ethereum, how do we leverage cryptocurrencies, and then you have kind of Bitcoin, which is we're gonna disintermediate all the banks, and there won't be banks and there won't be central banks. There'll just be Bitcoin, and you can send money across the world, very cheaply and nearly instantly, and you don't have to go through Western Union. Governments can't inflate the currency, all of that kind of stuff. So there's kind of these different ends, right? And like everything, it ends up in the middle. So that's kind of where, where we're more and more companies are trying to figure out what to do. Big corporations trying to figure out what to do about it, while being scared shitless about it.
Yeah, I had a talk with someone from
Mm-hmm.
they're saying how they're trying to implement blockchain out there, and then trying to sell it as a service to other companies.
Mm-hmm.
I feel like ultimately, at the end of the day, those are selling to the companies that jobs are replaced.
So yeah, and there's a long discussion too on private chains and public chains. So Bitcoin, Ethereum, these are all public chains. You can go and look and you can see every transaction that happened, right? But then there's private or permission chains is kind of the best way. There's things like Monax, and IBM's got Hyperledger, or Fabric technically, but the Hyperledger project, which supports that. I'm not a big fan of permissioned or private chains, because you still have that centralization, right? So IBM always uses the whole making sure that you're not buying blood diamonds and doing the provenance of diamonds coming from mine, going through market, ending up at a store. But at the end of the day, it's still like a somewhat centralized oligarchy of forces that are managing those consensus nodes. So they can still, there's still a way that you can, and so that's those are kind of the steps that, in evolving it, getting more business in tune with it. But I think really the public chains are where corporations need to worry about with smart contracts being able to remove. I think in Nevada or New Mexico, I forget where, but smart contracts can be valid in court. Like you can start like why do you need a lawyer? Why do you need accountants and banks and all this to sell my house? There could be a smart contract where if we both agree on the terms and money comes in, it could automatically send the deed and transmit, and it's on the blockchain. Anyone can look at it. They can see the contract, and it's there, like it's done. And I have my funds automatically deposited in my wallet, and we could do that in 5 minutes, right? So those are the types of service industries that this type of automation, this type of technology allows. It's all about decentralization and that, and really trustless. I don't need to trust you. I can sell you my house, but I don't need to trust you that you're not going to pay me because we have this code running and I can see the code and know what it does and know that when you put it in, I'll get my money and you'll get the house. And you don't have to trust me either. That's the whole goal of Bitcoin, being able to interact with people in a trustless manner. Whereas the old authorities were, lawyers and stuff, when they're acting as that escrow agent, they're the trusted party. But they can be bribed. They can be, people can be manipulated. Code is code, and you can look at it, right? So a lot of that, a lot of where we're at now with smart contracts is how do you make sure you're writing better code? How do you, for something so important, how can you test against it and understand it's doing exactly what you want it to do? And then how do you automate the translation of that into something more human speak, right? So.
What's going to incentivize miners as we get closer and closer to the max limit of 21 million Bitcoin?
Yep.
And the reward gets smaller and smaller.
So they still get the transaction fees. Okay. So at that point, it'll be they'll make money off the transaction fees.
Profitable to still mine though at that point?
That's a good question. I don't know, but that's some of the reason why Ethereum's looking to move more towards a proof of stake model. So I think you'll start seeing a lot more proof of stake type consensus mechanisms. But something else may come out too. I think that there's some hybrid proof of work, proof of stake that exists. So there's, like I said, we're super early. So the way things are now, are going to be completely different. But it's great because you have an opportunity to get in. I was a little too old, or I was a little too young for the first internet that in the web. So I feel like this is my version of the web that I missed the first time around, just being in so early.
How much is just unrecoverable? That
Probably a lot. Probably a lot.
No data on that, or?
There's guesses, but they go off of like idle wallet addresses, and you can see how much is in there, and they haven't moved any in or out. But maybe they're just holding, and they're not. Maybe they're just it's just sitting away. Or the person, I just saw some guy who bought a Lamborghini. He had this video. I bought a Lamborghini for $152 because he bought $152 worth of Bitcoin back in 2010, and forgot about it, and then went back and looked at it, and it went from 50 cents or I think it was $2 he said to 4,800 at the time per Bitcoin, right? So you have those situations where people were early on just mining on their laptops, and they had their private keys on there, and they didn't back up their private keys, and they were just mining, and there's private keys on there, and then they throw the laptop out and gone forever. So there's a good amount.
As a follow-up, any thoughts on Satoshi's million that are sitting somewhere?
He's sitting on them. Yeah, he's got the most. So I forget what his net worth is right now, but it's pretty good. So
Do you have any Bitcoin?
I do. I'm more of a fan of Ethereum than Bitcoin, but
This whole
yeah.
auto auction business is pretty much built ground up.
Yeah.
Ethereum, right, based on what you just said.
Yeah. I mean, I can decentralize. I can destroy my company right now by creating a decentralized version of it, right? So everyone's susceptible. So, but yeah, there's other really interesting cryptocurrencies been going to, like IOTA, which isn't a blockchain. It's more a DAG. So it's a graph, and it's really for micro payments, really fast machine-to-machine payments. And basically, so with Bitcoin, the larger the network, the longer it takes to mine blocks. Whereas with IOTA and any of these DAGs, the more transactions you have, the faster the network works to confirm. So that's other stuff we can get into. But yeah, there's a lot of other interesting cryptocurrency out there. I'm most bullish on Ethereum though. So I'll be slanted. You'll probably hear. I try to be neutral, but I always lean towards Ethereum. It's kind of the next generation. Like there was Bitcoin, and people tried to do a lot with Bitcoin, and it just wasn't built to do it, like smart contracts. And Ethereum is kind of that. Let's build this from scratch, but build it the right way with smart contracts, with a lot of other pieces that Bitcoin doesn't have. But Bitcoin's I'm the original, like we can't change anything. Everything needs to be the way Satoshi wanted it, So, but yeah. Anything else?
I feel like in this sort of organization,
To do what? Can't modify the past. You can't. No. So with proof of work, you would literally, so it's called a 51% attack. You would need to have, and I forget it's probably hundreds of billions of dollars right now. You would need to be able to buy enough electricity and machining resources to have 51% of the hash rate. And the size of it is, that's the beauty of it. You have to have over 51% to go back and rewrite the chain, and it just the cost of that is astronomical. So
like the government is decided we want to build a giant machine that's 51%. Could they? They just dump a ton of money into it.
Yeah,
do you have an answer there, Bina?
You'd rather be doing the positive thing and getting paid,
Right.
rather than doing
So-
the bad thing and spending the money.
Right. So, and some of it too. Okay, if you want to if you're going to do that, and you're going to take over the network, once that happens, it'll be known that you're over 51%, and then you're going to devalue, or people will just fork off. They'll fork a different version without you on it, right? But I mean, it's a lot. I forget how many hundreds of billions. It's a lot of.
Example is when Ethereum with a hard fork, the classic is about $12 or something.
Yep.
And whereas the good Ethereum, I should say that, but is about $400. So I think organically the good one will survive.
Yeah.
Because of the wisdom of the crowd.
Yep.
So if the country does do that, they'll be the only ones doing the blockchain. Nobody else will join them.
Right.
So,
They go fork off and do their own.
they'll
Yeah.
go bankrupt doing that.
Yeah, and it's like I say, that's the whole, the game theory behind it, is that it'll just be too expensive, and more people are adding different mining operations, that every day it just gets harder as the hash rate increases. The cost to do that is so much greater. So I mean, theoretically it's possible, but it's a lot. It's a lot of money, a lot of resources.
Proposition would be for them to do the blockchain, go with the blockchain.
Right. Yeah. Just make your money do it. Yeah. At that point, sit at 49% and just win most of the rewards. You'll be fine. But yeah.
You know, mentioned about like
Well, so there's basically with the DAO incident, they forked, and a lot of people didn't like that they forked the code to undo a lot of the damage that hack of the DAO. So they were siphoning off money, and I think it was like 60 million or so that was lost, and they tried to fork it to say, okay, we're going to stop this. Whoever, we don't want that person who, and it was very early on too, and they're like, all right, let's fork, and we're going to act as though that never happened. And it was early enough, and all the miners agreed, and they went their way. So it's basically someone doing a bad thing, and then the group's like, all right, screw that guy. Like we're going to this other way, right? So.
About 150 million was siphoned off by the bad guys.
Right.
And the good guys worked as a
right. Yeah.
siphoned back.
Right. They hacked the hack. Yeah.
And then they said we'll be very neutral, and you can go your way, we can go our way. So it's a democracy, and so they let them go their way.
Yep.
So
more of a religious split, but yeah.
And the people, the decentralized people of the world who participated on it, they decided to go.
Yep.
Right?
Yeah. It's like it's really like a religious split. Like you have the Catholics and the Lutherans, and like, well, I don't know, you want to go be Lutheran, go be Lutheran. You want to be Catholic, keep being Catholic. Like
also,
it's the same kind of mentality.
Like Dan pointed out, there's nothing bad about it. It's simply like he took care of DAO, naturally took care of. If that should happen in the future, we have a great way to care of it. You shouldn't look at it as a bad thing, but you look at it as a growing pain, and they handled it beautifully. And by the way, the lesson is that it was a programming bug.
Yeah.
That
Well,
is good programming.
Yeah. Well, and Cornell has a lot of like research into confirming that smart contracts actually do what you want and that there's no vulnerabilities in it. So that's a big area of research right now, at least in the Ethereum world, that making sure when you build these contracts, they are solid, and there's a lot that goes around it. So it was good that it happened so early on. It's like having a bug when you open a new product and you put it online and it crashes, but you have no users. Like that's the best time for it to crash. And then you're more paranoid and you do a little more testing and more validation going forward when you actually have, now that you have users, right? So I think in the long run it's a good thing. So, yeah. Anything else? Cool. Thank you. Yeah, I'll send this around as well. But yeah, everyone should read the Ethereum white paper, Bitcoin white paper. It's all good.